Let's think back to some of the biggest market moves in history. That huge crash in 2008? For most people, it felt like it just came out of nowhere. And then, a few years later, one of the most massive bull markets ever kicked off, right when everyone was still bracing for the worst. So you have to ask yourself, were these just totally random, chaotic events?
Or was there something else? A hidden signal, maybe? A little whisper in all that data telling us that something big was about to change. Most of us think markets are all about news and emotions, but what if the math itself, the actual language of change, could give us a heads up long before a crash or a rally really takes off? Well, that's exactly what we're going to dig into today.
So, yeah, when you first look at a market chart, it just looks like pure noise, right? But the problem isn't really the chaos. The real issue is that the tools most of us use are always looking in the rearview mirror. They're totally reactive, they're not predictive at all.
And this right here, this is the heart of the problem. Your classic tools, things like moving averages, they're great at telling you a trend was happening. It's kind of like getting a text that the party was amazing after the music's already stopped and everyone's gone home. So how do we get ahead of that? How can we measure change not after the fact, but as it's actually happening?
To figure that out, let's just step away from the markets for a second. Let's think about something way simpler, something we all get, driving a car. Seriously, this is the perfect way to understand the language of change, which really is all calculus is. It really just boils down to three basic ideas. First, you've got your position. That's just where you are. Simple. Then you've got your speed, or your velocity, which is just how fast your position is changing. And finally, you have acceleration. That just tells you if you're speeding up or hitting the brakes. It's the rate your speed is changing. See? Simple, right?
Okay, so how do we plug this back into the market? Well, in calculus, that idea of speed has a name. It's called the first derivative. So if a stock's price is its position, then the first derivative is its speed and its direction. If the derivative is positive, the price is going up. If it's negative, the price is going down. That's it.
So now we can take this whole car dashboard idea and apply it directly to reading a market chart. We're going to stop staring just at the price, and instead, we're going to look at the speed and the acceleration of that price. And believe me, this is where it starts to get really, really interesting.
I want you to picture this. You threw a ball straight up in the air. For that one tiny split second, right at its highest point, just before it starts to fall back down, its speed is 0. It's the exact same thing with market prices. At the very tip of a peak, or the very bottom of a trough, that momentum, the speed, it just momentarily stops. The first derivative hits 0.
Okay, but that leads to a really important question. If your car is stopped at a red light, your speed is 0. But your speed is also 0 for a moment if you're pulling a U-turn. So just knowing the speed is 0 isn't quite enough, right? We need to know what's about to happen next. Are we about to head down, or are we turning to go back up? And for that, we need acceleration.
And that brings us to the second derivative. This is the market's acceleration. It couldn't care less about the price or even the speed. All it tells us is whether the momentum itself is getting stronger or weaker. Is the foot hitting the gas, or is it hitting the brake?
And here is where it all clicks together. At a market peak, the speed is 0 and the acceleration is negative. That means the market has totally run out of gas on the way up and it's just about to roll over. Now on the flip side, at a trough, the speed is also 0, but the acceleration is positive. It's like the market has slammed the brakes on its free fall and is just starting to get some upward traction. This combination, this is what can give us a signal of a reversal before it actually happens.
Now, I know this all sounds incredibly powerful, and honestly, it is, but we've got to bring this back down to earth for a second. This is a mathematical framework. It's a lens for seeing the market in a new way. It is absolutely not a magic crystal ball.
Look, this kind of analysis isn't going to predict some sudden news event or surprise announcement from a company. What it does is measure the collective behavior of everyone in the market as it's reflected in the price. And because real-world data is always a bit messy, this approach works best when you use it with other tools, not just by itself. It's about giving us clarity, not certainty.
So what's the real value here? What's the takeaway? It's about shifting from just having a gut feeling to having a measurable objective signal. It's about adding a layer of discipline to how we look at things.
This quote really just nails it. We've all been there, right? You're looking at a chart and you just think, man, the market just feels tired, or it seems like the buyers are losing steam. What this approach does is take that intuition and turn it into something you can actually point to and measure, a speed that's dropping to zero, and an acceleration that's turning negative. It transforms a vague feeling into a real signal.
And that leaves us with a pretty fascinating thought, doesn't it? If the first and second derivatives can help us spot market turns by measuring speed and acceleration, it really makes you wonder, what other signals, what other deep patterns about how markets behave are just sitting there, hiding in the math, just waiting for us to find them?